What's going on, everybody? Welcome back to this series, How to Become an Investment Banker. I know it's been a while since we released part one, but with the transition in my schooling, at least, to online, it's been very difficult just keeping up with assignments and really studying for finals. So as we're kind of moving past that, I'd like to really get more into this series and start pumping out videos much more consistently. So without further ado, let's jump right into part two of How to Become an Investment Banker, which is the individual accounts on financial statements. So just as a quick recap, remember, last video, we talked about the organization and the structure of the different financial statements, that being the income statement, balance sheet, and the statement of cash flows. And now we're going to start to understand the content that's within those statements. And that all starts with the income statement. All right, so I know that we really touched on the income statement last time, and we kind of went through the generalized accounts on here, but we didn't really get into what they specifically meant and what some of the more individualized accounts beneath each of those tabs was. So we're going to really quickly kind of skim over what they are. Again, this is just to give you a general understanding of what things are. I hope that, especially if you want to be an investment banker, you've really studied some of these things and you've looked at maybe other YouTube videos or you learned in class what some of these basic accounts are. But if not, definitely do that. Again, I'm just kind of in these first couple episodes giving a very, very generalized overview of what these are. But they are very crucial to know because they kind of serve as the basis for really everything that we're going to be doing. So to start, we have revenue. It's very, very basic. It's just how much money you make through selling your good or service. So just think of it as the total money that you acquire from your sales. That leads into our cost of goods sold. Many times it's kind of abbreviated as COGS. So if you didn't know that, that's kind of what it means. And these are the costs that are directly attributed to making that good or service. So they're in the production process, they are then tied and linked directly to that certain product that's being made. And if we take our revenue and we subtract our COGS, that leads to our gross profit. Right? Some of the other expenses are going to be our operating expenses, and our operating expenses are all the other expenses that are very key to running our day-to-day operations of our business, right? Things like insurance, selling general and administrative expenses, that's like executive salaries, advertising, marketing, whatever it may be, our rent, things like that. And then we have a very, very important one, which is depreciation and amortization. And what this means, it's just the reduction in value over time of an asset due to it being used a lot, right? So if I had a big piece of machinery, over time, obviously it's going to slowly dwindle in value, just because it's constantly being used. Think about a car, right? A new car, the reason it's priced so much higher is because it hasn't been used. It has no wear and tear. It's got no miles on it, and people like that. It's very attractive, so it's got more value. But over time, as it's used more and more, it kind of loses value, and that's really the best that I can give of an explanation of depreciation. Amortization is a very similar way, just with non-physical assets, which we'll get into on the balance sheet section. But again, both the reduction in value over time of something. Just as a continuing of our income statement, that leads to our operating income. So if we take our gross profit less our operating expenses, we get the profit from our core operations of running our business. This is also known as EBIT, which is used in a ton of financial ratios. So just remember that operating income is the same thing as our EBIT. Other expenses, these are things that are not tied to the core business. These are things like interest expenses on our outstanding debt, gains or losses on the sales of various assets, and really anything that's not directly attributable to running that business day to day. All right, and then if we take that operating income, less these other expenses, that leads to our pre-tax income, and pretty self-explanatory, it's our income right before our tax. Our taxes, that's the amount of money that we're taxed based on that pre-tax income, and this varies based on location, so different countries have different tax rates, and then that leads to our net income. So now I know this may not be the most attractive way to really kind of run through the different accounts, but we're going to really quickly look at 3 different income statements and just kind of break down what's on them and what they might look like from the SEC. So this is the first income statement that I want to show you guys. This is Walmart, biggest company in the world. You should definitely know it. And so this is kind of the setup, right? So we have right over here, we have our revenues, That's what we talked about. And then again, that we have our costs and expenses, the cost of sales. It doesn't say COGS on here, but then we have our operating, selling, general, and admin expenses. That leads to our operating income. Then it's got our other expenses. It's got interest really highlighted on here, right? And then that leads to our income before our taxes, our pre-tax income. It's got the taxes, and then it's got our net income. This is a very strange income statement. We can look at another one really quick. Again, they're all going to look different, and it's very important to see how a company grows over time. So if you look up here, the revenue in 2018 was 495. This is in millions, so $1 billion, and that grew from 481. So you want to find growth rates. You want to find different margins. So like for example, if I were to take the operating income, the $20 billion, and divide that by the $495 billion, it would show me how much money or what percentage they get of their operating income from their total sales. And we find different margins, and there's a whole bunch of analysis that you can do, but it's always good to get on here. All I typed in was Walmart 10K, or you can just go to sec.gov and kind of search up any company that you want, and always go to their 10K. Another one we have is Johnson & Johnson. So we have a cost of the products. So we've got a revenue, cost of goods sold. That leads to our gross profit, right? SG&A, research and development, all these different operating expenses. It's got their interest income. It's a contra asset or a contra account. My apologies. It's got a whole bunch of different expenses, but again, that eventually leads to the net earnings. And lastly, we have, I don't even remember what company I did. This is Microsoft, sorry. And this is, again, shows their revenue. This is a much more structured one, which is nice. All their revenue up here, total revenue. That leads into their total product costs. Gross margin. It's got their operating expenses, operating income, right? Leads to their other income, other expenses. Then their income before taxes. And this is really kind of exactly what it looks like, and kind of how we described it, which is nice. But again, just to get more comfortable with these things, look up 10Ks. Look up, go on the sec.gov, type in a company, learn about it, read these things. They're a couple hundred pages, which kind of sucks, but look at different parts of it. Can only help you, and it just gets you more comfortable with these things. So without further ado, we're going to move into the balance sheet. I'm going to try to kind of speed this up because I know a lot of this for many of you guys is going to be a review. But again, if it's not, hopefully these can give just some quick generalizations. All right, guys, now we're going to move into the balance sheet. And something that's quick to note is that the balance sheet moves in order of liquidity. So the most liquid or the most easily convertible to cash are going to be at the top of it, and the least liquid, the least easy to convert to cash, are going to be towards the bottom of the balance sheet. That's pretty good to know, just to know the structure. But so let's just hop into it. Again, remember it's split into current assets and long-term assets, which are also called fixed assets. So let's go through some very general current assets. So we've got something like cash. Very self-explanatory. It's the money that you have on hand. It is literal cash. We've got accounts receivable, which is when you are owed money on a sale. So if I were to make a sale and somebody hasn't paid me yet, I am going to receive that money very soon in the future, and that'll go into accounts receivable. We have short-term investments. This is something when I invest in something and have less than a 1 year outlook on it. So it's something very short where I'm looking to make a very short investment. Just think of that. Prepaid expenses, when let's say I have to pay rent at the end of the month and I pay it off at the start. That goes into prepaid expenses because I already paid it. It's going to help me and benefit me in the future. Lastly, we have our inventory. This is obviously going to be the least liquid. Remember, this moves in terms of most liquid to least liquid. So at the bottom is going to be inventory in the current assets section. And this is the value of the current inventory that is in storage right now, or on your shelves or whatever it may be. And something just quick to note is that a lot of service firms will not have inventory just because they don't sell physical products. So that's always a benefit of a service firm. Right, so now let's move into fixed assets. We've got PP&E. This is definitely the biggest one. This is really the one that I would like you to pay attention to the most. This is plant, property, and equipment. That's what PP&E stands for. And it's usually the largest. It's things like land, buildings, equipment, anything like that. Again, very important, and especially on the cash flow statement. when we get into things like what happens when we buy these or when we sell these. Again, looking at intangible assets, this is kind of what we touched on earlier with amortization. So these are non-physical long-term assets. Now, when I say non-physical, that's things like trademarks, patents, copyrights. They're things that benefit us, but they are not actual physical things like equipment, for example, right? And there's also something called goodwill, which is the additional amount of money paid for a company during an acquisition. So if I were to buy a company and it's only valued at $100 million, let's say, and I buy it for $150 million, that difference, that $50 million, is going to be my goodwill. So again, quick recap, PP&E can be depreciated, intangible assets can be amortized. Again, reduction in value over time of one of these assets. These are what really get depreciated or amortized. And then we have our long-term investments, which again, very self-explanatory. It's an investment that I intend to be longer than 1 year. We're going to kind of fly through these. We have current liabilities. These are things like accounts payable. Think about it kind of as similar to an account receivable, but it's just kind of on the other side where you owe money now instead of are owed. So for accounts payable, if you owe money for something that you've already purchased. So if I went to my supplier and they already delivered stuff to me, but I didn't yet pay them for that shipment, I owe them. That's an account payable. Any other payables or accruals, these are accounts that you owe but have not yet paid. So these are things like income tax payables, interest payables, payroll payables, whatever they may be. And there's also accruals. So if you haven't, if you haven't yet paid off your taxes and that's kind of built up, that's an accrual. You still have to pay that. You've got deferred revenue. This is when someone pays you for a service that you've not yet performed. So the example that I kind of got for learning this one was, if I am an athletic trainer, right? And somebody comes to me and says, here's $500 for the next month. I want you to train my kid. I have been given the money, but I owe him my service, right? It's where someone pays you and you have not yet performed the task or the service that they paid you for. A good way to remember this conceptually is that it's kind of the opposite of accounts receivable. And if you can kind of piece that together in your head, just really step back and think about that. It definitely helped me a ton, and hopefully it does the same for you. We've got short-term debt that's due within a year, and maturity of long-term debt, which is long-term debt that's going to be due within the year. So that means it was long-term, but now it's coming due very soon. That leads to our long-term liabilities. These are things like long-term debt. Again, self-explanatory, total debt of a business that's due in over a year. And then we've got different bonds and notes payable, which is the different outstanding bonds that the firm has issued, or some of the outstanding debt that is due in over a year. Okay? And then we got our stockholders' equity, and that's something like common stock, which is ownership of the company. You should definitely know what common stock is. There's preferred stock, which is kind of that mix of stock and debt, where you're not quite given ownership, but you're given, kind of priority in the event of liquidation over common stockholders. Don't really worry about that a whole lot yet. Just understand that preferred stock is part of equity, and it's kind of that mix of stock and debt. And then there's treasury stock. This is a contra equity account, which means contra means negative, and it's when you repurchase shares of stock. So if I rebuy stock, my stockholders' equity goes down. And something to note, keep in mind from the last video, most important equation you'll ever learn in accounting: assets equal liabilities plus equity. Make sure that equation is always in balance. So all the equity accounts plus all the liability accounts are going to equal all of the asset accounts. Very, very, very important. And then we're going to lead right into our last example of the statement of cash flows. But first, we're going to really quickly look at the different balance sheets on the SEC. All right, so just for time's sake, we're going to just look at Walmart's balance sheet. Again, it's in the exact same document. Look at the 10K, and let's just kind of hop into it really quick. We have our assets, and under the assets, we have our current assets and our long-term assets. It does not label them the long-term assets, but it kind of gets into them, and it's kind of implied on here, so it's good to know the structure from the most liquid current assets, things like cash, receivables, to inventory. some of the least liquid things like property and equipment, buildings, whatever they may be, right? So again, it's just kind of good to look at it. It's got all these different accounts. Every company is going to have random accounts on there, but they all fall into the generalized categories that I've kind of outlined. So that's why I think it's really important to know these, and that's why I've kind of made a video on it, right? It may seem pointless to some people, but it's really good if you don't know the structure right now to know the structure and kind of what fits into each of these categories. Here's our goodwill. It grew, awesome. Look at how these different accounts change over time. Total assets of $204 billion. And then we look at our liabilities. Again, kind of what we talked about, short-term borrowing, so that's our short-term debt, accounts payable, long-term debt due within the year. We've got long-term debt. Equity, we got common stock, preferred stock's not on there, but we also have, wow, they don't have any treasury stock, look at that. Awesome. Yeah, but again, so it's the equation that I kind of highlighted earlier. Our total assets of $204 billion is the exact same as the total liabilities and equity, $204 billion. So again, this is kind of what it looks like. I really implore you guys to really just spend 10 minutes looking through the SEC and just understanding what some of these statements look like, just to get more comfortable with them, because you can never get too comfortable with financial statements, especially if you want to be a banker. So let's get into the last financial statement, which is the statement of cash flows. All right, so this is definitely the most complicated one, but definitely the most important as well. So statement of cash flows, as we kind of highlighted last week, it's the cash flow from operating activities, investing activities, and financing activities. So some of the things that you might find in here and what they mean, let's kind of dive into what that might look like. So again, cash flow from operating activities is any cash flows through the core business activities. That would be net income, obviously, because that's our core activities right there. That's the kind of link from our income statement onto our cash flow statement. We've got depreciation and amortization. It's going to be a cash inflow, and that's because it's a non-cash expense, so we re-add that back. The way that I want you to think about the statement of cash flows is in outflows and inflows. So if you're spending money or spending cash, it's going to be a cash outflow. If you're receiving cash, that's a cash inflow. Again, some of the cash flow from operating activities are changes in some of the various accounts on the balance sheet. So changes in inventory, accounts payable. So if I wanted to raise my inventory, it's part of my core business activity, right? Anything kind of like that. And this could be a whole bunch of different things depending on the company. Next, we have our cash flow from investing activities. This is the purchasing or selling of equipment. This is referred to as CapEx. CapEx is capital expenditures. So if I were to purchase equipment, right, that's a cash outflow because I'm spending money. If I were to sell equipment, it's a cash inflow. I'm getting rid of the equipment and I'm getting cash. And again, that's how I want you to think about these different accounts on the statement of cash flows. Lending and borrowing money. If I lend money, cash outflow. If I borrow money, that's a cash inflow. And again, think about how these affect the different financial statements. So if I borrow money, it's a cash inflow, my cash goes up. But if I borrow money, that also means I have to repay it back, which means my either short-term or long-term debt's going to go up. And also, the next year, my interest expense is going to go up because I'm gonna have to pay interest on it. And that's how you really should start to be thinking about these things. Start to connect how the different statements connect or are linked, and really just try to understand all the different ideas and concepts behind each one. And then the purchase and sale of various investments. So again, purchase, cash outflow, sale, cash inflow. Lastly, we have the cash flow from financing activities. These are ways in which I raise capital, and usually that's going to be done through either debt or equity. Usually. I'm not, that's a very generalized statement. But cash flow from financing, this is any cash which helps the corporation finance its ventures. So if we have the issuance of debt, if I issue more debt, then my debt is going up. And if I repay debt, then I'm paying it. So it's a cash outflow. If I issue, cash inflow. Now you're probably thinking, what's the difference between financing activities? I thought I just saw debt on investing. That's just if you lend or borrow money. This is if you issue or repay, right? So just think of how it's directly helping you finance the business versus just kind of trying to raise money and make the most out of that money, which is more investing. Financing is how you're raising money for yourself. Same with the issuance and repurchase of stock, and then dividends. Dividends are that small sum of money that are paid to investors for holding onto a company's stock, and this is also going to show up in the cash flow from financing activities. And we're going to look at our last financial statement, and we're going to look at the statement of cash flows of Microsoft just because it's really laid out very nicely. All right, so here is Microsoft's cash flow statement. And again, they've highlighted it awesome. They've got the cash flow from operations bolded, financing and investing. So from their operations, they've got net income. There are various accounts that they changed, right? They've got accounts receivable, inventories, other long-term assets changing, current assets changing, accounts payable. However those accounts change during the period, and they're going to be balance sheet accounts, that's definitely reflected in our cash flow from operations. In various accounts up here, we've got goodwill, depreciation, amortization. Again, those are non-cash expenses. That's why they're added back, right? They're positive numbers rather than negative. We've got a negative number right here, recognition of unearned revenue, because we recognized it, but we haven't yet earned it, so it's a cash outflow, right? But really just piecing those together. Our financing activities, there's the proceeds from the issuance of debt, issuance of short-term debt, repayment of debt, common stock issuances, repurchases. We just kind of cover those. And then lastly, our investing activities, the additions to property and equipment, acquisitions, purchasing of investments, maturities of investments, sales of investments. And again, they're going to be different based on the company, but they are all in these generalized categories. So I definitely recommend you keep looking at these, and we'll just kind of get on to the last point. Awesome. All right, so I know that this was a pretty long and drawn out video. I tried to make it as quick as I could, but a lot of these I did not do justice. I kind of skimmed to the surface. If you don't understand one of these things, do not go any farther in trying to understand what free cash flow is, different valuation techniques. Don't try to get to that high level finance stuff until you really understand at a core level what a lot of these accounts are and how they link. How they link is the most important part. And if you can take away anything from this video, I would say to look at different SEC documents and also to really just break down in your head what is going on with the different statements. If one thing changes, how does that affect all three? So hopefully this helped as much as it can. I have 3 quick recap questions that I think I'm going to leave you with, and hopefully they help. So the first one, can you name 3 various accounts in assets, liabilities, and shareholders' equity on the balance sheet? Just name 3 in each, and again, try to think about how they affect each other. Why is depreciation a cash inflow? And then also, what is deferred revenue? I think if you can get these 3 things, you're definitely well on your way to understanding what a lot of these concepts are. And next week, that will finally lead us into part 3, which is understanding free cash flow. So next week's when we really kind of hit the ground running. Instead of just focusing on accounting terms, we're gonna get pretty in depth into some of these more banking concepts, and this will lead into a lot of the more technical and high level finance concepts. So thank you guys for tuning in. I really hope you enjoyed, and I really hope you got something out of this. If you don't, or if you didn't and you still have questions about something, feel free to go into the comments or just watch another video. There's some great YouTube videos out there. There's some great teachers, and they really can get in depth. Some of the videos are really long, probably like this one. But again, if you can understand it, it's worth the time. Trust me. So thank you guys. I will have another video coming soon, and I look forward to seeing you all in the next one.